Good morning, ladies and gentlemen. Well, as you can see, the risk dial is still broken. The manual calculation gives us about -5, so not dreadful, but definitely not good. And now we can see actually why it started warning us back in late November and mid-December that things were really looking a bit wonky and for risk. And now we understand. We have the pivot from the Fed, we have the pivot from the ECB. The Bank of England pivoted a long time ago. So what this is basically saying is that liquidity is reducing worldwide. If we get another a pivot from the Bank of Japan, that will really be significant as well. So things are really going in the direction of higher rates and lower, a higher risk premium and therefore lower prices. Let's examine exactly what the bonds did this week and try to summarize what that implicates for what the implications are for the path of risk prices for the next week. Right, well, since Europe had the biggest moves, it's only fitting that we should begin with Europe. This is the Schatz, and you can see that basically we've covered the whole range in one day, a day and a half, a 6-year range in a day and a half. If we switch this now to a weekly view and go back, here we go to where the data really begins, right around 2013. We can see that in a week we've done just about more than in several years. The pivot has been tremendous. Inflation, I've been saying it for a while, inflation is a global phenomenon. You either have inflation worldwide or you don't have inflation anywhere, really. And the ECB has finally recognized that. They've thrown in the towel, and now the tightening cycle has begun in Europe as well. They will stop QE and they will slowly then jack up rates. What does that imply for the 2-year? Well, I really see this kind of level around -9 as, a target. I think, we're likely to remain around these levels for a while because the changes are not immediate. They're announced, but they're not immediate. The market is, of course, going to discount, but I think the risk reward here is to be flat. When we get some more time passing, and I'm talking about weeks, I'm not talking about minutes, then we have to reset, looking for these kind of levels and then eventually positive. Having a small position looking for positive at the moment is probably not a bad idea. I am flat. I've captured this whole move. I'm pretty damn happy, and I don't want to think about the Schatz for the next, several weeks. But the picture is definitely negative. If we switch this to a 5-year view, this move here was just as significant as at any other time, say from here. And you can see really that we don't really have much until we get to something like 25 basis positive in the 5-year. Now, what a change from thinking that -55, -65 was appropriate. And this is in a month. A month ago we were thinking that, is it -50? Is it -55? Well, here it is. It's -10, and it's probably going all the way to 24, 25 positive. If we look at the 10-year, this is the Bund. This is basically saying 26, 27, 28, a bit of sideways, and then we're going somewhere around here, aren't we? We're going to the 60s. These are very, very big moves. And as I've told you, as QE leaks out of Europe into the US via the US dollar, that will lessen the risk appetite for everything. The clearest chart has always been France to me. It's achieved the target that I had here at 64 basis points, and the next one, if we switch to a weekly view on that one and expand, well, here it is. We are looking at somewhere around 90 basis points for the oats. It's unmistakable that the path of least resistance is up after the Fed pivot. And the most interesting chart, the one that I've been saying that you really have to watch out, is this, the differential between tens in the US and in Germany. If we go back, if we go back to a weekly chart, and oops, no, we can't do that because of but let's go back to the daily chart. I really think that this area here around 158 is very important. How do we get to higher rates in Europe is very important. Are they matched almost tick for tick by the United States? Because if they are, we are going to have some enormous volatility in all asset classes. If this remains around this 175 level to 182 level, and we get the targets that I just showed you in bunds, in oats, in bobble, then I think the risk premia are going to expand significantly, and we're going to have a very rough time, a very volatile time in all equities. If, however, this breaks down, that will mean that it's only European rates that are going up, and it's not US rates that are following them, and that will mean relative stability. So this is the chart to look at. I would have thought another couple of weeks of staying elevated, and my favorite is that we break down lower, which will have implications for the dollar, but not so much for equities. In the US, the yield curve keeps on flattening. This is 2s 10s. It's achieved almost my target around the 55 area. I've been saying for a long time that 2s 10s is going into the 50s, and here we are. I think a period of stability is called for, but that is just me. It's unmistakable and undeniable that the yield curve in the US keeps on flattening, and that eventually is a harbinger of not so good things for the economy. The economic surprises index keeps on going down, and basically the bond market is saying that at some stage we're going to have an accident in the economy. I'm finding it hard to disagree with the bond market is saying, especially when I have a look at 5s 30s and 10s 30s, which we will look at now. Okay, so 530s, this is a weekly chart. It just won't stop. It's relentless. We are here at what should be minor resistance around the 41, 42 area. What to say? I don't see why it's flattening at the moment. I think it should pause, but a pause is not a reversal of trend. The longer term trend is unmistakable in every single tenure. If we look at even this is 10s, 30s, we're seeing that they're getting to levels that, we were last at the, at around the beginning, middle of 2018. And this is really why I'm beginning to think that we are, somewhere around 2018 as a match for equities. And you can all go and have a look at what happened in 2018. Very much similar situation, Fed in a similar stance. And now we have the added kicker of the ECB turning, pivoting bearish and hawkish. So I can understand why the bond market is worried. Even the flat 10-years, 5s, 10s. I mean, we are getting to the levels that they've been at in 2018, the flattest levels that we have seen for many a decade. If that flips negative, and I think it might well do, you are going to have a very strange yield curve, basically with twos. It'll look something like this. Twos will be down here, fives will be up there, tens will be down here, and 30s will be down there. Fives will be the hump in the curve. That's going to be very, very interesting. And that will suggest that the Fed is wildly behind the curve. We shall see. I think the bond market is speaking very loudly that it is afraid that there's going to be an accident ahead. Okay, let's switch to the individual tenures of the yield curve and see what they're saying. I've switched the fives here to a weekly chart just to show you the importance of this level. I mean, look at it here and look what happens when it started busting it. We basically had a whole year of going up and basically up by 1%. I think if that happens now, it's going to have a not good effect on equities. Simply because I don't think the world can take much higher rates. I don't think the world can take rates up at 3% in fives. As simple as that. This is do or die here. Can it spend several weeks going sideways? I would hope so. But if it doesn't, and if it starts going here to 213 to start off with, and then does this kind of a pattern and stays between 213 and 177, and then goes up again, matching what happened here, I think you're going to have a period of risk premium going out, of credit spreads going out, of whole things that are volatility inducing happening, and nothing good lies ahead for risk. It is very, very important, and this is what I'll be looking at all week next week. Do we go up? Do we come back? Are we, can we stay in this kind of 145, 177 range? And is this the top for a few weeks? Because if this is the top for a few weeks, you can have equity recoveries, and we'll look at the levels, but it won't last. Okay, it won't last, because if all it does is piss around in a 20 basis point range and gets ready to break higher, then all you're looking for are levels to sell equities at. If we change that to tens, now this is the weekly chart in tens, that has room to run more than the fives without being too worrying. But the fact that we're taking out these highs, to me, suggests something, and I'll show you what it suggests. It suggests something like this. It suggests that this was the high, this was the low, and now we can go to somewhere around here. That would be a steepening, possibly, and that is quite frightening. You can see what it did in 17 and 18, and this level around 233 to possibly 260 is really not out of the question, which would suggest to me that what we are doing is basically that the differential between bunds and 10-year notes might stay constant. Yes, that chart that I showed you earlier, and I said that very, very important. This actually suggests that it will stay constant. So the pressure won't be on the dollar as much as it will be on rates, and that will have significant impact on risk premium. If we have a look at the 30s, and this is a daily chart, you can see that now we are at this very, very pivotal 224, which corresponded to that thick line in fives. And I had that thick line in fives, and I've got this thick line in 30s. And if we actually change this to a weekly chart, you can see how important that is. This is the low for 2015, and this is where the 200 period moving average comes down. Excuse me. If we now start breaking upwards, well, we can have, as this chart suggests, and every time it's done it by quite a bit. We could easily go down up to here to around 293. These are enormous moves, and if we do something like what we've had before on the 10s, if we do something like this, and go up here and down there, even at 61, it's taking you to 270. These are big moves, okay? So what I'm saying is the market is threatening big moves here in the bonds. And, God forbid that we should go to these kind of levels where it's always gone very, very quickly when it's broken through the 224 area. God forbid. I also wanted to show you this TLT chart, which is a weekly chart. And here I have my 127.37, which is so important. And basically it's been a level that the market has traded back to wherever it's been, well, all the way since almost God was a boy. I think we're going to touch it. It really looks like that is what's going to happen in the next several months. And that has, bearish risk implications for risk prices. I think bonds and equities are fundamentally tied together. And, even if we, and this is what I keep on looking at, it's just, even if we say that, okay, we'll forget about that, but say that the real move started there and it finished here, and then it, it's giving you this area, it's giving you this area, 127 and maybe, around 120, 115. As the last wave. So I just cannot be bullish of bonds. I just can't be. I think the question is, do they hold for a week or two and then go? And that is really as good as I can see it. I really can't see it stopping here. I think is going to take this out, take out the previous low. I mean, the least I see trading is 132. 127.37, very high probability. And lower than that, okay, lesser probability, but I think it's also very, very possible. Well, the unexpected, or the timing of the unexpected pivot by the ECB naturally hiked up the value of the euro and smacked back the dollar. It's actually held 95.07, which to me was the beginning of the trend, of the change of trend rather. What does this mean? It all hinges around that chart of the differentials between tens and in Europe and in the US. If that remains almost constant, I would have thought that the path of least resistance after a few weeks of consolidation is actually going to be back up to 98. If that breaks down, it's coming down to 93.14. On a day-by-day basis, what you have to do is see if it breaks 95.07. If it doesn't break 95.07, wow, then really I think that the path of least resistance is proven to be up. If it does break 95.07, it's going to 93.63, and that is really going to be the really important level, because that is more or less what the 200-day moving average is, and that will be the decision. Could it do a quick A, B, C? Yes, absolutely. I think that is possible. But to me, this area between 95.07 and 93.63 is going to be absolutely key as to what I think the dollar is going to do next. Again, it'll be a question of following that differential chart and deciding, as you saw, the room for US rates to go up is even higher than the room for German rates to go up. And to me, that suggests that the differential is going to remain constant for a bit. And I just can't get bearish of the dollar at the moment. I think, can it trade down to the 94s? Yes, but I think it's actually going to be a very good level to start reversing and looking for higher dollar rates from that level. If we look at, this is now the chart of Euro USD, on a weekly basis, all it's done is basically, can we get to here? 115.47, yeah, and that will probably be all she wrote. Look at this, 116 maximum. To me, this is not really something that I'm all that interested in running from here. I'm probably more interested in fading. But my guiding light is going to be the differential between Germany and the US. I'm probably just as sick of talking about gold to you and repeating myself as you are of listening to me. But, when you're right, you're right. 1764, 1830. That is your range still. And when you think about it, what the reasons are, well, the reasons are the reasons. They haven't changed. You have bond yields going higher, and you have the dollar not really going, not going that much lower. But you get the dampening effect 1 week when the bond yields go up. You have the dollar go down, and that basically dampens the volatility in gold. as one force counteracts the other, and you get more or less nothing. And this is precisely what happened. You got more or less nothing. Where is the next big move going to come from? Well, as I've just explained to you, if I'm right and the dollar doesn't really fall apart, and then all it does is go to 116 against the euro and then back down, but bond yields keep on going up, then that dampening effect is actually removed and you get a move down in gold to around the 1710 area. Do I think that's going to be a good buy? Yes, but it's many, many weeks away. I don't think we really need to think about it. When will we know that some kind of a move in gold is underway? Well, we will know if it closes on a weekly basis below 1764. Hasn't done that for, years. So okay, that's a year. Let's wait. Let's wait and let bonds and the US dollar give us the direction. At the moment, if you want to have a position, you buy straddles at 1764, depending how cheap they are and how long. Because if it goes down to 1764, I tell you, one or two things is going to happen. It's either going to go straight back up to 1830, 1880, or it's going to fall apart down to 1700. End of story. 1764 is your big pivot. There isn't really that much more to think about. And with that, I will leave gold for quite a while. The one that I'm pleased with is my call about gold DBC. If we enlarge it, it's coming down to 638, baby. It's, the hedge against inflation is DBC. It's not gold for the time being. And here we are, we're on our way to 2439, which, is the last wave. Now, be careful. I mean, from 23 to 24, it's another 5%. Can he get that? Yes, sure he can get there, because the thing that's actually taking it up there is oil. And here we have a very important level around 97 something, which goes back a long, long way. Don't forget, this is a weekly chart, right? So I think we're now beginning to be on fumes, and we get there. You can really start exiting DBC wherever it is, because CL is the main driver of DBC, and that will be that basically. You don't really want to be long up here, not unless you think that Russia's going to nuke the world, and then all you're going to get is spikes. But you can't position looking for a war. I mean, who does that? This is, if you're portfolio positioning, you don't do that. You trade a war. You trade the spike. So you are now beginning to run out of air here. You can see that basically this is the fifth wave and last wave, most probably. And, we've had a huge run, basically from zero all the way to $100. A little bit of moderation in expectations, I would have thought, would be warranted at 97 something. So there you have it. I think the DBC is, has another couple of percent, 5% up, and that's it. And I think that is because oil is going to top. Why would oil top? Well, one possibility is because the economy might top itself. Let's start the equity review with the Blue Angels. As we've seen in the earnings that we've had, the economy is going great guns. Profits are strong, profit margins are strong. The Blue Angels are still rising. Okay, they're still rising, and they will continue to rise. I don't see that. We've had the main companies report. We've got several weeks of a lot of companies reporting. I don't think the forward earnings curve is going to change much over the next weeks. I think it'll still be going higher. The question is as to the multiplier. And for the time being, I don't see a lot of change unless and until the bonds break those levels that I've indicated. When they do, I'm firmly convinced that the fate of bonds and the fate of equities is very much tied together. And as I wrote in the piece on yesterday, all we can expect is a decision whereby the right Blue Angel to go up is times 18, times 20, or nearer times 22. That really is all we can expect. I don't think we're going to see a flattening of these forward earnings for quite some time unless we get an accident in the economy. Our expectations of economic growth coming down, yes, they are. But I don't think that is enough at the moment. The economic surprises are coming down, the PMIs are coming down, all sorts of things are coming down. But the bond market is saying something quite different at the moment. And really the only thing that can break the economy is the bond market. So let's see. Let's keep an open mind. I think as long as the bonds keep on putting the pressure on, the upside is very much capped. And then the question becomes, do we just trade sideways and then break down and then up? We will see. It all depends on bond yields. Well, one thing that is for sure, as I wrote to you, 45.37 is the mother of all swing levels in SPX, and you can just see it all the time. Even on intraday charts, you can see it. Can we get to 46.46? Entirely possible, okay? I mean, absolutely entirely possible, and then that becomes some sort of an ABC. That to me is not so much the question. The question to me is where is the bottom? And for various reasons, I think this area around 42.55 is going to be the bottom for quite some time, until and unless bonds break. I think the fact that the US dollar is taking some of the strain, the fact that the bond yields are at a very, very good resistance and are unlikely in the next week or so to give us any kind of a signal. I think any dips, even down to this 43.84 area, are probably going to be contained, and it's going to hold for the time being. I don't think that we have enough information yet to decide that the path is down. I think we have all the indications that bond yields might ruin the party, but until and unless they do, I don't think I think that the earnings and the prospects for earnings, as I showed you in those Blue Angels, are enough to support it, if you understand what I'm trying to say. So could 46 be the top? Entirely possible. It would fill some gaps, it will get some people bullish, and then boom, straight back down. I think the best way to play it is via that option strategy I indicated to you. And if you have a better idea, please write to me and I will be more than pleased to run the numbers for you. But I think, up here we're running on air, and down here we are running on fear rather than mathematics. NQ actually did quite well. It did as well as I could expect it to behave last week. Touched my resistance at 15,111. And these moving averages are now turning. These are weekly moving averages. I think another 2-3 weeks of up and down. What level am I looking at? What level would I love to see to try and maybe do some kind of a short? I would love to see this kind of area between 15,320 and 15,600. This is more or less this 15,600 level in where this moving average is 200 period. I would love to see that. That would indicate to me that some people are getting even bullish, and that to me is the ideal level to buy puts. So there you have it. I'm not that negative on the markets yet, until the bond market proves to me what it wants to do. And it's at such good resistance levels that I showed you, it would be natural for it to sort of just spend a couple of weeks going sideways and then pull the rug. So I think longer term options are the way to go here. Sell the shorter term puts, buy the longer term puts when it gets to this kind of a level. The one market that could actually start moving more than the US is Europe. I think being short of Europe and long of the US is not a bad trade at the moment. The credit spreads and the risk premia should start moving out in Europe now that you have the pivot from the ECB. Do I think 3,986 trades? Yes, I do. And do I think 3,844 eventually trades? Yes, most probably. If you have a look at a daily chart of the DAX, I think a break of 14,760 is going to be very significant. Look at what we will be trapping up there. You could just get a wave down of selling. Let's have a look. Boom, boom, up there. We could easily see it touch this kind of area, this kind of support, which is around 14,000. So I think for the next couple of weeks, it's probably advisable to be more short in Europe than it is in the US. This is a daily chart of SPY over FEZ, which is the Europe basically in constant dollars. You could easily see it spike through the highs here around 1024. Which, just to give you an idea, and that's why I do this, we're around, let's call it 10 at the moment. So from 10 to 1024 is another 2% of outperformance by the SPY over the FEZ. So basically, even if ES didn't move from where it closed on Friday around 4,500, you could get another 2% fall in the value of SPX, not SPX, ESX, the European, the stocks. That could fall another 2% relative to that level. I'm sure that would have, that would drag down the ES or SPX by another percent, let's say. So you're looking for a 3% move in the European stock markets and a 1% move in the SPX. So that's the kind of thing that you're looking for. You're looking for at least a 2% move, and it could easily be more of outperformance by SPY against the Europeans. So concentrate your shorts in the European equities for the time being. Nikkei actually, got from the oversold level and bounced from the very important 26,195, and now it's going to really struggle to break 28,180 and certainly 28,335. Basically all it's done is corrected in time, not so much in price. I mean, very little in price, not even, well, what is it, 0.382, something like that of this move. This to me says that my levels in SPX are actually more or less right, and that these moves are going to cap it, and that the whole equity sector is actually doing some kind of a topping stroke, finding the top of the range for the time being. It's very much like here in EM. It keeps on not being able to hold above 50, even though you have some very good, news for EM, like a lower dollar. All indicates to me that equities will slowly over the weeks, not very quickly, head lower. And the low is going to be somewhere around 45.04. That to me suggests that the dollar will not help that much. And it's just going to be bond yields that actually hurt. It's going to take some time, but I think it's happening, and I think that's far more likely than that we rally at any stage here. With that, I have changed the levels. I would give the European bonds a miss for the next week or two. Do I think the yields are eventually going higher? Yes. I'm nice and flat, and I'm not going to put on sizable positions for the next couple of weeks, I don't think. Is it a sell the rip market in equities? I think it is. I think if you see that the levels that I mentioned in my in the piece I prepared on Saturday, I think buying straddles at 45.37 is a longer term straddles. I think is a winning strategy, and I will definitely be doing it. I think it will be a sell the rip market. Can it get to 4,600 odd? Yes, it can. But I don't think it stays there, because I don't think bond yields are going to allow it to stay there. I think bond yields will eventually move higher. Whether it's immediate, I don't think it is. I don't see why it would go immediately unless the big money decides that it needs to get out. But we will see. I think the levels that I gave you in the bonds, the absolute levels, are very, very, very important. And when we start breaking those pivots, those thick lines that I showed you in 5s and in 30s, I think the market is going to feel the pressure. I think all the risk markets are going to feel the pressure. The pressure for the next few days should be on the stocks. But when those markets start breaking, the bond markets start breaking those levels, the pressure will be on everything. And that is just the way it is. Don't forget the leakage out of QE from Europe, from Japan, from the Bank of England, from everywhere is going to stop, and the market is going to discount that it's going to stop before it stops. It's not going to wait till March. It's not going to wait till June. That's not the way markets work. It'll anticipate that that is going to happen. That's going to provide some bargains for some people, but it's also, which basically means buy the dip for the people who are preparing themselves, but also sell the rip because, bad news and more risk premium expansions are coming down the road. That is without a doubt. Any kind of a rip is a sell. We are not going to have that much good news coming anytime soon. Thank you very much indeed, and tweet you on Monday.